This is a trading profit and loss video. It's for Colin Buckley. We're going to do a trading profit and loss. I'll just zoom on this in here. We're going to do a trading profit and loss and a balance sheet, and we're given a list of information. We have enough information to complete both accounts. So let's start with the first one. Is a trading profit and loss. Title at the top is simply trading profit and loss, and you have the details. You can put in for Colin Buckley. But the details of the date is for the year ended 31st of May 2007, the date that's given. The figures are in dollars and they're in thousands, so I'm just going to show that they're just so the examiner knows that the figures are in those units. Okay, so the structure of a trading profit and loss is something you have to memorize. It's quite straightforward. It's seeing how much profit a company has made at the end of a year. So they're doing their financial year up to the end of May. First thing we have is sales, revenue, sales, or in this case, turnover, which is kind of more of an American term. Turnover is the amount of money that you've made throughout the year, as is revenue, as is sales. The figure is given, 2750, and that's given there. So you find out how much money you made, and the next thing you need to look at is what were the total costs for the production? What were the total costs of the ingredients or the materials and all that kind of stuff? It is directly related to the goods, so that if I am producing tables, this is the cost of the timber. I'm not looking at other expenses like electricity or like rent or anything like that. I'm just simply looking at the cost for what I'm producing, and it's the cost of goods sold. And so my revenue is 2750. My cost of goods sold will go in here, and then I'll find my gross profit. Now in this question, it was, I suppose, a little bit unique. They actually didn't give us the cost of goods sold. But as long as you understand how this process works, which they required you to know obviously, they gave you the gross profit, which is unusual. Usually you'd have the revenue, you'd minus the cost of goods sold, and then you'd have the gross profit. In this case, they just gave you the gross profit. So what are you going to do? Well, we know already that revenue minus cost of goods sold is gross profit, so we just get the missing figure, and that's working backwards. We can find out the cost of goods sold that way. But usually, if you're given it and you take it away from revenue, you get your gross profit. They did a very similar thing here. They actually did the next thing here is expenses. These are your electricity, your rent, your wages, insurance. These are your normal random expenses that a company has that don't have to do exactly, they don't have to be expenses that are directly related to your product. So we're not, if we're producing tables, this is your materials for the tables, and this is your just general expenses. It's a negative figure. Obviously, you're spending this money, so that you'll take it away. And usually they'll give you the figure and you'll just take it away. But in this case, they haven't given you the expenses. But if you know your stuff and you know the structure of this, your gross profit minus your expenses is your net profit. Sometimes called net profit before interest and tax. And they gave you that 190. So again, it's pretty straightforward. Usually you'd add these up and you'd have this and you take away your expenses and you get your net profit. So in this case, we just have to get the missing figure of 335. Gross profit minus expenses, 190. Just to summarize what we've done so far, all you need to remember is this is the sales and this is the cost of sales. This is the cost, so we take it away. That's the first thing. You get your gross profit, and this is the profit that's directly related to the goods. You then take away all the other expenses, and then you're left with your net profit. There's only 3 more things that you need to do, but this is a pretty clear version of the profit that the company has made. But to be absolutely clear on it, we have 3 more things which could come up, and in this case they do, that we need to take away. All 3 of these are negative. The first one is the interest that you owe the bank. Interest on loans, things like that. So interest is going to be negative 35. So I'm going to take that away from my net profit, and I'm going to get again, subtotal net profit before tax, because I've dealt with my interest of 155. So I've had my net profit. Interest is a negative thing, so I take it away. The next thing again is tax. It's pretty straightforward. Tax is going to be negative. I take away my tax, and now I'm left with my net profit after interest and tax of 130. There. So again, I've got my net profit, take away interest, take away tax, and again I told you the last thing that you could have is dividends. May not always have it. If you don't have it, then you're finished here. You'll call that your retained profit. but in this case we do have it. Dividends is money that you owe to your shareholders, and so it's a negative figure. You're going to spend the money, give the money back to the shareholders, and it's now gone from the business. So this 100 is gone. So now my profit is technically now down to 30. And so this is called my retained earnings or retained profit. So this is a statement of comprehensive income, profit and loss, can be called either. All you have to do is your sales minus the cost of sales gets you gross profit. You take away all the general expenses and then you have your net profit. After that, you're pretty close to being done. You just need to take away interest, tax, and dividends. And between each one of those, you need to have a subtotal, and then when you're finished, it's called retained profit. That is the profit and loss for column 1.